Chainlink didn't underperform in 2025. Chainlink signed more institutional partnerships last year than almost any crypto protocol in existence. Governments, banks, payment networks, market infrastructure, and the token, the price, barely moved. Most people would see that as failure, but institutions see it differently because the most important signal isn't price, guys. It's when price is allowed to matter. So retail investors, us retail investors, me and you, guys that buy our crypto on Coinbase or Kraken or wherever, we tend to track narratives, but institutions track dependencies. And in 2025, something unusual happened. Chainlink became the embedded into systems that don't speculate. They integrate, they standardize, they lay down, and they wait. And this only matters if you notice what happened next, and more importantly, what didn't happen in price. Later in this video, we will explain why stagnation can be structural progress. But let's walk through 2025 for Chainlink without conclusions. The US government chose to publish macroeconomic data on chain. In 2025, they published their macroeconomic data on chain. Not experimentally, operationally, and Chainlink facilitated it. Its co-founder, Sergey Nazarov, held repeated meetings with White House officials. MasterCard enabled over 3 billion cardholders to access crypto via a Chainlink-powered application. UBS tested fund workflows on Ethereum using Chainlink standards. Swift did the same. Then something quieter happened. Chainlink, Swift, DTCC, and Euroclear began building shared institutional rails, not products. And that is the main point of clarification. They are building the rails, not products. This resulted in no token narrative, no market cycle, just focus on building the infrastructure. So here's the signal most people are going to miss about Chainlink in 2025. Chainlink stopped behaving like a growth protocol and started behaving like real middleware. Middleware doesn't pump early. It just becomes unavoidable at first, hiding in the shadows, but needed. People depend on it. It becomes unavoidable. But look at what followed. JP Morgan's Connexus project ran cross-chain trials using Chainlink. Central bank initiatives like Drex also followed. S&P Global Ratings moved stablecoin assessments on-chain via Chainlink data link. WisdomTree published institutional NAV data on-chain. Deutsche Bank bought multi-asset market data on-chain. FTSE Russell indices followed. And guys, this isn't adoption for speculation. It's adoption for settlement, right? There's probably, the list goes on with the number of partners Chainlink had in 2025. And we've seen this pattern before. Infrastructure gets absorbed first. Then the valuation follows. And this, my friends, this is why structure matters more than the headlines, and why price stagnation doesn't always mean weakness. When institutions build quietly, they're not timing the markets. They're locking in dependencies. So what changes in 2026 for Chainlink? Not hype, not narratives, access. The ETF channel will open, and liquidity can finally touch the infrastructure. Guys, we just saw Bitwise launch 13, or not launch, apply for 13 different altcoin ETFs. Okay, being able to invest in the infrastructure through ETFs is coming. And if optimism returns to the market, Chainlink doesn't need a new story. It already sits inside the pipelines. So when we're talking Chainlink above $20, probably not a prediction. It's going to be a reflection of when infrastructure becomes visible to capital. So one takeaway here. Price lags structure until it doesn't. If you want to see these shifts before they're obvious, that's what we do here. So you know what to do. Hit like, hit subscribe, and we'll see you in the next one.